We detected two unusual trades, one of which was $6.3 million on Moderna stock, ticker symbol MRNA. And so in this video, we will analyze this unusual option activity to find out if these wealthy investors are bullish in buying Moderna or bearish in selling Moderna, so that we can also trade in the same direction to make money while the rich are getting richer on Wall Street. Because as we all know, the rich have more access to information, including leaked insider information, to make better financial decisions. No wonder the rich get richer. And so without further ado, let's dive into our analysis. Now, as you can see here, Moderna stock dropped to a new low recently. And on this day, which is January 17, it actually started to come back up. And on January 17, you can see here that Moderna announced they were receiving funding from the US government to develop a bird flu vaccine. And so could these unusual trades be related to this bird flu vaccine? We may never know, but what we can know is what direction they were trading this. Are they bullish or bearish on Moderna now? And so if we take a look at the data on the options time and sales tape, we can see the first trade here, 14,660 contracts being traded all at the same time at 10:46. These January 24 options at the 37 strike call and the 40 strike call, and the January 31st options at the 45.5 strike call and the 41.5 strike calls. And so let's take a deeper look at the option chain to find out more about these unusual options that expire January 24th. We can see here that for the 37 strike calls, the open interest was 17,000, which is greater than the 14,000 being traded. And also at the 40 strike calls, 16,000 open interest. And based on our analysis, they were closing out of these trades, taking profits from that recent rally since January 17 and rolling to the January 31st options here. And you can see this trade at the 41.5 strike calls, clearly opening trades, because you can see the open interest is much less at 39. The volume being traded today much greater, and also at the 45.5 strike calls as well. Zero open interest. So definitely not possible to close out of any trades at this strike price. And you can see based on our position here, POS stands for position, green means buy, where they bought the 41.5 strike calls and they sold the 45.5 strike calls. And so we bought these call options and sold these. And when we analyze this trade, you can see that this trade on the risk profile profit loss graph, where the share price is represented on the x-axis and the y-axis represents the profit loss. Note the zero break even. And so when the lines are below it, it is a loss. And so if the stock, which is currently trading right here, trades down, it becomes more negative loss. If it goes up, it becomes more positive gain, because this is a long bullish trade. And we can see here on the Greeks, we have a positive delta, confirming it is a bullish trade, because if it was a bearish short trade, it would be a negative delta. And so this first unusual trade was going long bullish on Moderna. Well, let's take a look at the options time and sales tape to see the price that they paid. As we can see here, they closed out of the January 24 options. And so these are their trades here that are new opening, where they paid $82 for the 41.5 strike calls. They sold the 45.5 for $25. And so each trade was $57. And we multiply by the number of contracts, 14,660. And you can see that this trade cost $835,000. Now keep in mind, this trade is a higher risk trade in comparison to the trades that we share on our website. If you want better trade ideas, then make sure to go to our website.
Visit www.unusualoption.com to join our membership and start your journey to a financial success with a partner you can trust.
We will also put a link at the top here where you can gain access to strategies to reduce risk while increasing the chance of profit. Now for the second trade, as you can see here, 14,000 contracts being traded here. These were done at the same time as these other trades at 1:08 p.m. And so we need to take a look at all these March 21st options at the 40 strike puts, 100 strike puts, 70 strike puts, and the 110 strike puts. And we can see here on the option chain for these March 21st options, at the 110 strike puts, we had an open interest of 2,000, which was the number of trades they were trading. And at the 100 strike puts, 3,000. And at the 70 strike puts, 2,000. And based on our analysis, they were closing out of these three put options and opening a new trade here at the 40 strike puts. We can see here that the volume much greater than the open interest of just 3,400. And so now that we know that which is the opening and closing trades, we can calculate the total trade costs. We can see here that these three options are the closing trades, and this one here is the new opening trades, these 40 strike puts. And so they were being traded for $4.55 each. And since there was 14,000 contracts, we multiply that out and we get $6.3 million, much more than the other trade in call options over here. And so we also got into this same position as well. You can see here for the March 21st options at the 40 strike puts, where we also bought these for $4.55. And so when we analyze this trade, we can see here that these put options are clearly bearish, because as the share price goes down, this trade becomes more positive profitable. And if it goes up, it becomes more negative loss. And if we take a look at the Greeks, we can see that the delta on this trade is a negative delta, which confirms this is a short bearish trade. And so we are trading both of these at the same time. And you can see that by including both of them together, this is what our trade looks like. You can see here on the blue line, it actually starts to become profitable above the zero break-even line if it rallies considerably, especially in the short term, because these options expired January 31st. And so we are net bearish, because if you take a look at our total Greeks now, by putting both trades together, we have a negative 30 delta. And so in the short term, we are bullish with call options, but after January 31st, we are bearish. And so that is how we are trading Moderna. It is a higher risk trade because we have opposing directions of unusual option activity, bullish and bearish. And so this decreases our probability of profit while increasing our risk. So we use position sizing to manage our risk. If you want to gain access to the higher probability of profit trades with lower risk, then make sure to go to our website. We'll put a link at the top here where you can gain access to the trades that wealthy investors are trading. Let us know in the comments below. What do you think will happen to Moderna? Do you think in the short term it will perhaps fill this gap and then drop back down like those unusual trades? As usual, please hit the like button, subscribe if you haven't. Take care and have a wonderful day.